Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Well, today, I think I owe some of you an update on-chain. It's been a while since we've looked at that data, but enough of you have been asking about what's been going on the Bitcoin ledger that I thought I owed some of you an update today. So we'll spend some time looking at a few on-chain data points. We'll also try to get a perspective on the Fed's raising of the terminal interest rate and see how it compares to hikes in the past and see if we can decide how high we think the rates can actually go. So don't go anywhere. We've got a bit of a mixed schedule today. I am currently traveling and will be back home in early July, at which point we'll catch up on all of the current events of the market. If you enjoy my content, please give my video a thumbs up and subscribe. I appreciate your support and it lets YouTube know that you like my content. Now, enough housekeeping, let's get to the data. And what we really will start with today is a look at exchange balances. So there's been a lot of talk about exchange balances over the last year and a half, 2 years. My opinion on it has waffled a bit. I used to think they were more meaningful than I do now. And at this current juncture, I just don't feel that exchange balances have much to do with price action at all. You know, we can see in certain instances that there are big inflows to the exchanges as a group, and those tend to occur near periods of a lot of selling. And that makes sense because the exchanges are where most of the markets are. So in order to get rid of your coins or give them to someone else, you've got to put them on the exchange. But other than that, the perpetual non-stop outflow from exchanges that we've been seeing over the last couple of years, shown in this gray area chart on the top of the screen, this kind of perpetual downtrend has been giving some people a false signal, I believe, a false signal of some kind of long-term squeeze in supply. But I believe that this is flawed, and partly because there are still over 2.4 million Bitcoin on exchanges. That represents over 10% of the supply that's still currently sitting on the group of public exchanges that are tracked by Glassnode. And I think, over the last year and a half, seeing this number kind of always going down with the one exception of the big inflow here in May and June, I think that generally this downtrend has given people the feeling that when coins are leaving the exchange, it means the number is going up. It means that there's less and less coins available for sale. And that isn't exactly strictly true. What coins are available for sale are sitting on orders in the order book. They're passive orders. And that's only a fraction of the supply that's actually sitting here on these exchanges. The vast majority of this is idle, is not participating in the market and deciding on price. So they're really not affecting what happens to Bitcoin's price. So the balance on these exchanges can go up or down, and the price can still do virtually whatever it wants. So moving forward, the way that I'd like to really focus on exchange balances is looking for those big inflows. Because if we lack the granularity about where the outflows are going to, we really can't talk very much about Bitcoin sovereignty, about coins going into cold storage, because as I mentioned, there's still well over 2 million of them on those exchanges that someone at any point could go put up for sale if they wanted to. Meanwhile, the liquid order books tend not to really care about these balances. Another reason why I think it's inaccurate to assign an intent to this continual outflow from exchanges is because we're only seeing part of the market here. This list of exchanges at the top of this chart are the ones that Glassnode has hooked up and are tracking. It's the ones they have confidence in, either because they've gotten an API hookup directly from that exchange, or they've been able to identify some of their addresses on chain using a bunch of complicated methods, or some combination of the two of those things. And it's allowed them to have enough confidence to show you that this is Coinbase's balance or whatever. But the thing is, this isn't all of the exchanges. This isn't all of the liquid markets for Bitcoin. This isn't all of the places that decide on price and available supply. Now, it is a lot of them. It's most of the well-known ones, but there are a lot of places where Bitcoin is transacted, exchanged, where business is taking place that isn't being represented here on this metric. And if you think about all of the other websites that provide this data, CryptoQuant, CoinGlass, Levitas, all of those different sites, they all have their own list that they're tracking. None of the lists are exactly the same. And so I'm really bringing all of this up because I want you as my audience to understand the nuance in these on-chain metrics. Because I see a lot of people posting things about exchanges going down and expressing some kind of a bullishness. And I believe that that's falsely applied to a metric that doesn't really have anything to do with price. But on an interesting note, something recently occurred. Binance passed Coinbase as the largest holder of Bitcoin among popular exchanges, among the ones that we can see. So while we don't know that coins leaving these exchanges are going to Joe Schmo Bitcoiner, they could be going to some other hedge fund or institutional firm or trading house or what have you. While we don't know exactly where all those flows are going, one thing that is curious is that the largest North American exchange, which has represented a lot of the institutional buying in North America over the last couple years, their balance is shrinking, whereas Binance is growing, which represents a more global audience. They have a lot more traders and retail speculation on Binance, and their balance recently passed Coinbase. Binance is now the king of all the exchanges. They have the most volume, and now they have the most Bitcoin. Two exchanges going in opposite directions. And because of the size of Coinbase for so long, its perpetual outflow has been pulling down the total sum of exchange balances. But now that Binance has actually passed them, and Binance, for its part, is growing long term, we may begin to see exchange balances flatten back out as these two forces work against each other. And when you look here at Coinbase, you see these like stepwise changes to this metric. It looks like a stair step. It's almost as if there's a large institutional player pulling Bitcoin off of Coinbase methodically over a series of months. I can't say exactly what's going on there, but this change has been one that's been coming for a long time, and we can now say with confidence, Coinbase has been dethroned. This is a look at on-chain support levels. So we haven't touched on this chart in quite a while, but this represents the cost basis of a couple of different groups on the Bitcoin ledger. This first orange line is the realized price. It's one of the most fundamental metrics in Bitcoin on-chain. It represents the cost basis of the entire ledger. It's the price at which all coins last moved, last transacted. And it's pretty frequent in bear markets that we go below the realized price. Well, we have done that. The realized price is at 22,600 and we are trading below there now, which means that the Bitcoin network as a whole is in loss. Now, for long-term investors like myself, people who aren't necessarily trading, people who aren't looking to take profit in the near term, for people like myself, and this is not advice for anyone, I'm not qualified to give advice, but I find this to be a value area. I don't know how long price will spend down here. I don't know if it will go considerably lower than this, but I'm prepared to manage that situation. Now, again, this isn't advice for you, but that's a perspective that I've had for a while, and I'm not alone in sharing that. The realized price is one of those kinds of value triggers, in my opinion. Now, beyond just the realized price, we're also below the realized price for long-term holders, the cost basis of long-term holders. Now, a long-term holder, if you're not familiar with that term, is an entity on the Bitcoin ledger that has had their coins for 5 or 6 months or longer. There's been some research done over the years that's determined that once a coin sits stationary for 5 to 6 months, the statistical likelihood of it being spent in the future is severely diminished. So once a coin sits for that long, it's weathered some volatility by that point. Typically 5 or 6 months of Bitcoin exposure will show you a considerable amount of volatility. And while it's not a guarantee that those coins won't be spent again, the likelihood of them being spent falls significantly. So when we get below the cost basis of these longer term investors, that's an even more significant value signal. And it also is a signal of intense bearishness because people who hold their coins for a long period of time tend to have a cost basis that's much lower than price because Bitcoin itself grows in an exponential way on a 3 to 4 year basis. Most long-term holders are in profit most of the time. However, right now, long-term holders as a group are are in loss, just as the network as a whole is in loss, just as short-term holders, those are people whose coins have been moved in the last half of a year or so, that group has been solidly underwater since early December. Price tried to reclaim the cost basis of these short-term holders in March when we had Do Kwon from the Luna scandal and we had Michael Saylor of MicroStrategy both TWAPing 9-figure stacks of Bitcoin for a period of time in February and March. Price tried to get back over the short-term holder cost basis, which was also really close to the 200-day moving average. Well, we know price got rejected, and so the short-term holder group continued to experience severe loss and bloodshed. But now that price is all the way down here at 20,000, even the long-term holders now find themselves underwater. And what does that mean for long-term holders, that they're underwater now? Well, it means that some of them are spending. This chart up here at the top shows the 14-day change in long-term holder supply. And what you can see is that it is minus 1.3%. You see, there's been a couple of instances here where this value has been printing negative. These show instances where coins from the past that are considered long-term held are being transacted for whatever reason. Either they're being sold to someone else, someone is moving them to position them for a trade. Who knows exactly what's going on, but we know that a certain amount of supply is being moved. And when long-term holders have 13.5 million coins, they have over 70% of the supply. 1% of it being spent in a 2-week period is not an insignificant amount of coins. You know, we're talking 130, 150,000 coins. So there has been a bit of volume coming out of this group. But if you look at periods where they've had their extreme amounts of spending, it's usually in market strength. That's one of the patterns that makes a hallmark signature for long-term holders. The majority of their spending, the highest volume of it, comes in strong markets when price is ripping up exponentially. People who have held for long periods of time are spending into that strength, taking profits, paying themselves for taking on risk. That kind of behavior is predominant in a bull market. And you can see this group distributes heavily in the bull and supply gains into this group. It sits, matures, and graduates into long-term holder supply in a bear market on the backside when the supply goes idle and it stops moving around. We had that same pattern here in 2021. Distribution into the top as it broke the previous all-time high, acquisition of supply on the back end as network activity waned and a bunch of supply sat dormant for 5 to 6 months. But then over here in weakness, we're seeing a bit of distribution. It's not anything like these larger events, but it is a notable amount, and it's the largest amount of spending out of the long-term holder supply since back in January of 2021. In an effort to see who exactly is spending, this is a look at something called the spent volume age bands. Now, each one of these rows represents a group of coins from 3 months to 6 months, 6 months to 12 months, 1 year to 2 year, all the way down to 7 to 10 years. And each of these little blurbs of color represent spending volume out of that group as a percentage of daily transfer volume on the entire network. Now, each of these axes are independent from each other. So a big blurb here down in the 5 to 7 year group doesn't mean that this amount of spending was more than all these other groups. You can see this axis is representing 0.5% of daily spending volume. For some of these other more recent groups, they can be as much as 1 or 2 or 3%, sometimes more of daily spending volume. But the real thing to look at here, kind of ignore some of this noise in the past, is really over here. You see these swells of spending here in the recent past? These are from June 4th, June 7th, June 11th. These are pockets of spending out of coins that are 3 to 6 months old, 6 to 12 months old, and 1 to 2 years old. The 1 to 2 year old group, relative to the volume it normally sees, is showing a pretty high amount of spending. Now, people who have coins that are 1 to 2 years old, those are people who bought in June of last year, 2021, all the way to June of 2020, right? 1 to 2 years ago. And if you think about where price is right now, it's currently not that far away from prices from that range of time. June of 2020 to June of last year is right here, and price smack dab in the middle of it. So we're seeing some spending out of people who have coins in this general area. They're feeling themselves under pressure, and they're transacting some of their coins. Maybe they're worried that they'll lose their profitability. Maybe they're worried that they'll get even more in the red. Maybe they're holding from up here. Let's see if we can unpack their profitability a little bit more. Here is a look at activity out of the long-term holder group. So there's a couple of lines here we've already talked about. This was the regular old realized price, the cost basis of the whole network. This is the realized price of long-term holders, the cost basis of people who have held coins for 6 months or more. And this red line represents the average price of long-term held coins that are being spent. So this is the place that they are being spent from on average. And what you can see is that it is well above price. The average cost basis of long-term holders that are choosing to spend at this moment in time, it's around $35,000. So they are spending in loss, which is a very rare behavior for long-term holders who typically enjoy long periods of time in healthy profit. It's not quite enough to call it a capitulation. I'll be careful about using that word. I don't want to give the wrong impression. It's not a full-on capitulation, but it does represent a weakness in this cohort. And I believe that it's in part due to the price action, right? If you think about past bear markets for Bitcoin, it rips 10x, 20x or more, and then there is a massive drawdown. Usually it falls 70 or 80% in a very swift amount of time, like a month or two. There's some really violent bounces along the way, and it doesn't come back to that top price for sometimes 2 or 3 years. That's the most recent pattern here from 2018 to 2020. However, what we got here in 2021 was not a peak and then never returning to it. In fact, we gave people another bite at the apple just a few months later. Not only did it create some weakness in people who would normally have become hodlers by the nature of the massive bear market, but because they got a second bite at the apple, we even suckered in some newer buyers. Buyers that at this point in time, now 8, 9, 10 months removed from this price action, those people are considered long-term holders as well. And some of them are spending from prices that are above where we are now. They're fearful that perhaps they made a bad decision. Maybe they made a poor investment and they're not so sure about the future. Maybe they need to cut costs. Maybe they need some liquidity to pay their bills because of inflation. It's probably all of the above if you consider the whole group. And right now they are spending in loss on average. A rarity for them, but a sign that we are in deep value territory for Bitcoin. We are probably at the depths of the bear. It doesn't mean that we're at the bottom. This could go on considerably longer. We're kind of at the whims of the economy and the central banks in that regard, but it's pretty clear that we are firmly in the middle portion of a bear market. We're not in the early bear anymore. We've gotten below the realized price. We've gotten below the long-term holder cost basis, and they are spending well in loss. And it could be some time before we see activity picking up again. This is a metric called value days destroyed multiple that's of my own design, and it measures on-chain spending volume as a ratio of historical volume. You can see it really spikes heavily in bull markets, it recedes quickly in bears, and it's very low. It's down below the 50% mark, which means that more than half of Bitcoin's life has seen higher values for this metric than what we have now. When we start to see transaction volumes picking up on a month-over-month basis, it starts to accelerate. You see this? It sets higher highs. On each pullback and subsequent rise, it gets a little bit higher and it starts to build and it builds upward. That could be the sign that the network is recovering, but we're probably a few months, maybe a year away. It's hard to say timeline-wise. I'm not going to commit to a timeline, but it's pretty obvious that the chain is very quiet. Transactions are taking place. We're seeing some long-term holders spending, but generally the volume across the ledger is pretty low, particularly compared to the last year. So I think that we're in the depths of a bear market, smack in the middle of it. Not sure how long it's going to go, but we're seeing some of the hallmark signs of being maturely in a bear. Now, the last thing I want to touch on today relates to the federal funds rate. There's a lot of discussion on Twitter about how high the Federal Reserve will be able to raise interest rates. And it's important for what we were just discussing, because until they back off of tightening financial conditions, assets like Bitcoin are probably not going to see high voluminous inflows of capital. So this is very relevant to studying our market. This is Sven Henrik. He's at Northman Trader on Twitter. He's showing here the federal funds rate. This is the rate that gets changed when the Fed talks about interest rates. And then the rest of the treasury curve and the cost of capital across the market responds to this terminal rate. And what you can see over the last several decades is that it's been in a perpetual downtrend. There's an easing cycle and then a tightening cycle. And when it eases and begins tightening again, it's never able to get back above the previous tightening cycle peak, right? You see this? And this is in part because of our levels of debt, which is this moving red line in the background. This is total public debt. And as it continues to rise, it has an adverse effect on the Federal Reserve's ability to raise interest rates because that raises the cost of capital into the future. There is a constant payment on debt. So when you raise interest rates, future debt becomes more expensive. Now, there's a lot of talk about, can the Fed really raise? Can they raise above this red line? And if they do, would it break something? Would they actually be able to raise above the previous cycle peak, which is around 2.5%? I think that's an interesting question. Let's explore it in a different way. What I've got here is the same chart, okay? This is the federal funds rate in blue. This is the federal funds rate here. But you'll notice how this one is setting lower highs each time. The difference here is that this federal fund rate is pretending to be an interest payment on total public debt. So I just explained to you how public debt is growing, right? It's this red line here. It's been growing and growing and growing and growing. So if we think about the federal funds rate, which is the terminal interest rate that governs cost of capital across the market. If we think about the federal funds rate as an interest payment on the debt that the government owns, we can get an idea of how high we think they can push that rate before it starts to look historically unstable. So this wiggly dark line here is federal funds rate as a percentage of total public debt. So total public debt is around 30 trillion as of right now. And what I did was I charted it over time. I pretended that it was an interest payment. And what you can see is it continually sets higher highs on a pretty reliable trend line that is the polar opposite of the downward trend line on the regular chart of the rate itself. So we've got some pattern matching here. Each of these colored lines in the background, they represent a make-believe rate for the federal funds rate. 1.5%, 1.75%, 2%, 2.25%, 2.5%. That's the different colors here up to purple. And then this green line represents the interest rate the Fed claims they are targeting for 2023. They are targeting a 3.8% federal funds rate, which just for reference puts them back at around 2008 levels of interest rates. That's where this circle is on Sven's chart. But the real takeaway here is if you assume that because rising debt levels mean that a rising interest rate increasingly has an effect on the cost of that interest payment, it looks like the federal funds rate will kind of have to stall out in this general area. Because if it were to go above here and set some kind of a new paradigm with current debt levels being where they are, it would create some serious instability in the financial system. So I believe that by looking at it in this particular way, it opens the door for us to say, you know what? Somewhere in this area here, which represents a 2 to 2.25% terminal rate, seems to make a lot of sense. One thing that I can say with certainty is that the 3% rate that they have targeted for the end of next year looks absolutely insane when you think about it as an interest payment on our outstanding debt. It seems utterly ridiculous and unfathomable. And the only things that really look even remotely realistic are rates in and around 2 to 2.5%. Now, as I mentioned before, the previous high was about 2.5%. So we're actually getting some confluence here, suggesting that it will be difficult for the Fed to raise the rates simply because of the debt load. Now, to take this a step further, I'm looking at a couple of other data points. Same chart, federal funds rate as a percent of public debt. We've got a couple other data points on here. I kept the 2.5% terminal rate in this purple line. I kept the green line, which is that 3.8% target, which is crazy, but I've included a couple of other things. So this teal line, which starts here at the bottom, and then you see it kind of really volatile, bouncing around. This represents what's called the TGA, which is the Treasury General General Account. That's essentially the checking account of the Federal Reserve. And that balance is $950 billion. Now it chops around a whole lot. It goes from 600 up to $1 trillion, down to 800, but it's got about $900 billion in it right now. The brown line here represents total government defense spending. It's currently up around $900 billion. It's close to the balance in the Treasury General Account. The 3.8% federal fund target rate means that if they actually got there, the interest payment on that debt would be $250 billion more than our annual defense budget. Really encapsulates just how unrealistic that target of 3.8% really seems when you look at it through this lens of what it would actually cost us to deal with that. Now that's in a vacuum as well. It's not this straightforward. It's not like they raise the rate, they pull money out of the Treasury General Account, and they pay the bill and they move on. This is a very simplified model, but I think it makes a powerful statement about just how strapped they are because of how quickly these debt levels have been rising and because of this long-term, multi-decade trend. I really think somewhere in this neighborhood of 2.25% is probably about as far as they're going to be able to go. And by that point, I suspect, and we'll find out here in a couple of months, we'll find out by next month if I'm right or not, I suspect we may start to see things unraveling and looking really fragile if they start trying to push beyond there. I don't know for sure. Obviously, these are just my opinions. I'm trying to project. It just seems very unrealistic to think that we're going to enter a new rate paradigm when we have historically high debt. So we talked about exchanges. We talked about how I don't think they're very relevant for price action. I also talked about how Binance recently dethroned Coinbase, which is interesting. We explored how price is now below the cost basis of many of our important cohorts. And as a result, the network as a whole is in loss. This is a severe value area for long-term investors, but that does not mean that we are near the end of the bear market. It could go on for months or years. But if you have a long-term perspective and you are thinking about a place to begin slowly scaling into a long-term position, areas that we're in now should be appealing for those kinds of perspectives. There are a lot of investors that consider price below the realized price to be value. They may not have enough buying power to stave off another leg down. Those would be driven by macroeconomic factors. We saw a little bit of distribution out of the long-term holder group, which we haven't been looking at very closely. It does seem that people who bought maybe in the second all-time high run in October and November of last year, or perhaps people that held from the beginning of last year, are spending near their cost basis or in loss, which is a sign of being deep into a bear market. It's not so deep that I would consider it an alarming capitulation, but it does show weakness in a group that is otherwise considered to be one of the stronger-handed owners of Bitcoin. We also talked about possible end results for the federal funds rate and how it compares to interest payments on the public debt. And it really feels like 2 or 2.25%, maybe 2.5%, somewhere in this range here is probably a realistic end target, assuming things don't start unraveling before they get there. So we bounced around a lot today. I covered a bunch of ground. I hope that if you were looking for some on-chain data that I scratched that itch. I also hope that you understand now why we haven't been looking at it so closely. Volumes are very low, and the market is being driven by economic and geopolitical factors. If you enjoy this content and you want to see more of it, make sure you follow me on Twitter at TXMCTrades. It's where I post a lot of my thoughts and my market observations, and then I bring them here to the videos. If you enjoyed this video, please subscribe to my channel and hit that thumbs up button. It really helps the algos to recommend me to more people, and it supports my ability to keep making this content. I am currently traveling, and I'll be back in early July, where we'll talk about whatever happened while I was gone. So in the meantime, find some time to relax for yourself if you can. Take care of yourselves, be kind to each other, and we will chat again in the very near future, friends. Cheers, everyone.